Well, welcome to the Debt Matters podcast, where we help Canadians find solutions to their debt with licensed insolvency trustees from across the country. I'm Wayne Kay, and in today's show, we're going to talk about these payday loans. You may see them on TV, hear them on radio, see them in ads. And are there other debt traps that we need to avoid? To find out more, I've got Matt Fader joining me from Allan Marshall and Associates in Halifax, Nova Scotia. Hey, Matt, thanks for being here.
Thanks for having me.
And this is kind of what you deal with is people going into bad debts and then not knowing how to get out of it. Are these payday loans good, bad, ugly? What are they?
I would say that they're certainly not good. I mean, they serve a purpose as far as high interest emergency loans, and they come with very high risk associated with them. And the high risk demands a high repayment term. And they are very much a trap. When we look at a conventional lending, so I don't know how much you know about conventional lending there, Wayne, but there's 60% interest is considered racketeering. So it's illegal to charge 60% interest, okay?
60%? That's insane.
60%. Okay. But it is perfectly within somebody's right to charge 59.9% interest.
No.
Absolutely. And that is the consequence of some of these payday loans when you default on the payment. Now, I don't know. I'm going to assume you don't know how they work.
No, I have no idea. My jaw is on the floor. 20% on a credit card to me is outrageous, and I figure that they should be in prison. Never mind. It's 59%. So yeah, please tell me how this works.
Okay. So a typical payday loan is based and they're really not charging interest on a payday loan, which is kind of a little bit how you skirt around it. And this will be apparent if you ever read the contract of somebody who's into a payday loan. But basically you pay what's called a borrowing premium. So Wayne, I'll lend you $100. I want you to pay that $100 back on your next payday. But I want you to pay me $20 on top of that $100 for the privilege of borrowing. And that's basically how they work. So you're paying this premium based on what it is that you borrow. So somebody who borrows $500 for a payday loan to skirt them through, the next pay they're expected to pay the $500 back plus, say that $20 per 100. So it costs them $600 to borrow that $500. So when you think about that, if you're paid on a biweekly pay schedule, you go in, you borrow $500, you pay the $600 2 weeks later. If you borrow that $500 again, because you know what, you don't have it, the following week you got to pay another $100. So in that time, they've made $200 off of that $500 that they've advanced you. The problem is that, and the trap exists where it says, okay, here's my but I really need that $600 back. So they end up borrowing $600, which means the next time they're going in, they're paying that $600 back plus the $20 on top of every 100. So now they're paying $720. And more money it's costing them more and more money. And what we typically see is we'll typically see people with multiple payday loans because they go to this one to borrow, this one to go over here to pay this one off to reborrow, and it just skirts around all over the place.
Why do people do this? What's the reason?
Well, a lot of it is there is a certain degree of desperation that comes with it. Unfortunately, I'll talk to a lot of people that might have addiction problems that I'm saying, okay, I understand that. But, you have people who either have low income, they're overextended, they're just desperate for money to be able to buy food or make payments. It does constitute a form of some of them constitute a form of predatory lending. I don't want to paint all payday loan people with all, the negative brush, but, a lot of them, it does boil down to some degree of irresponsible lending. That being said, they make their money and they serve a purpose. And for somebody who says, look, I'm $100 short this week, and I can afford the 120 and I'll never borrow again, then they are perfect service for that. I don't want to go through the bank. I don't need to get a loan for $100. I just have this emergency that came up and I'll be able to pay it next week and I won't get into that trap. Then it's actually a service that could be beneficial to them. They can afford the hit and their budget is sound enough to say, just maybe there was I had to take 2 days off of work because I was sick or whatever. And I just needed that little bit extra cash to float me over. So, they do serve a niche purpose. The unfortunate thing is that there's a lot of people that are taking it, that are using them, and they're unaware of what the consequences are as they get into the cycle of trying to repay them. And of course the damage it can have on their finances, their health, their credit, carrying that stress associated with it can be a very terrible burden for somebody. So they are something to be cautious about and to really understand what you're getting yourself into. You don't want to just get into one because you say, oh, I want to get a piece of pizza tonight. So you really do want to make sure that you're aware of the consequences that come with it. And at the same time, what are my strategies or my techniques to get myself out of the payday loans? Right.
Okay. So are there other risky lending things I should be avoiding?
Well, there are other finance companies out there that are not going to be quite as egregious as that, but they'll give consolidation loans. I've seen consolidation loans that would range anywhere from, a bank loan at 8% to one with a finance company, at 40%.
Wow.
I've seen a second mortgage on somebody's house through a financing company at 28%. And I'm like, this is a second mortgage at 28%. Goodness gracious. And that's secured against their house. They have to pay that or that secondary lender can start a foreclosure proceeding against them. And that's one of the things that you do need to be careful about if you have assets, because we have run into it on numerous occasions where they say, oh yeah, I owe 20 grand to this finance company. And I say, okay, great. And I do a search and I'm like, do you realize this is attached to your property and this is a second mortgage? And they're just completely floored by it. They just said, oh no, they just said, sign all these papers and we'll give you 20 grand. And they were unaware of what they were actually getting into. And that's a very, very dangerous thing when you're talking about one of your larger assets.
Yeah,
being your house.
Okay, so I think that's a great red flag for people to be paying attention to when they're in this situation. Is there anything else that pops in your mind, stories that maybe you've seen something else like that people should be aware of before they go signing on the dotted line for anything?
Well, yeah, I mean, a lot of it does boil down to say, what is the cost associated with servicing this? For somebody who says, well, I want to consolidate, I've got 4 credit cards and it costs me, $100 a month on each of these cards, and that's interest only. So they go out and they get a loan, and if the loan payment is $500 a month, you're like, are you any further ahead for what you've done? But one of the other things that you do need to keep in mind, especially in relation to these consolidation loans, is they are installment loans. So they do have a defined end. Which is different than a revolving loan, which just sort of keeps going that you can borrow against. So for somebody who says, well, I'm paying $100 a month on 4 credit cards, so $400 a month, and I'm not getting anywhere because it's just making the interest only payment. If they were able to restructure their debt so that they say, okay, well, I can pay $400 a month through this installment loan, and in 5 years, that installment loan will be paid out, then that's actually not a bad solution for them, because at least they put an end in sight and their $400 is going towards reducing their debt rather than treading water. The danger that comes with a consolidation loan, and I mean, if I had a nickel for every time that this happened, I wouldn't be a rich man by any stretch of the imagination. But Wayne, you and I could both get some pretty delicious hamburgers with those nickels. The thing is that what happens is you end up being overextended. One of the worst mistakes you can make when you get a consolidation loan is to not reduce or close off your available credit. to keep those credit cards open. Because what will tend to happen is if you haven't adjusted your spending, if you haven't adjusted the way that you actually spend your money and live your life, you will start to fall back on that credit. And I've seen it time and time and time again, where a year ago, somebody went out and got that $30,000 consolidation loan. And a year later, they're coming to see me saying, well, they owe $28,000 on that consolidation loan and $30,000 in credit card debt.
Oh, no.
Because they didn't adjust their patterns. They didn't adjust their lifestyle. And, that $400 that was going on the credit card, that went towards the loan, but I still don't have money to buy food. No problem. I'll put it on the credit card. And then before you know it, boom, they owe twice as much.
And we're taught to use our credit cards, though, because you get points. If I use my credit card, I get points.
Yeah,
right?
It's a great way to do it,
and
right?
You don't pay any attention to how much it is. I know people who've done this. They have no idea how much they're putting on the credit card because it's quickly they just tap it or they hit their little PIN number, and all of a sudden they're kind of surprised when the end of the month comes and there's more payment than there is actual income.
Well, yeah. And I mean, that is very much a product of our current environment as far as spending is concerned. You have to keep in mind, and Wayne, close your eyes and let's go back to the Wayback Machine.
Okay, let's go.
Okay, so once upon a time, it's Thursday. Your boss comes around, shakes your hand, says, "Hey, Wayne, thanks for shaking me," and hands you this piece of paper. And this piece of paper for the youngins out there is what was called a check, a paycheck. And he or she would hand you this paycheck, and you would look at your watch and you would say, "Oh my God, it's 2:20." And the bank would only be open until like 2:30 because that's where bankers' hours came from. Right. So you'd run out to the bank. And you'd get in this line, and what was at the bank waiting for you was this big line of everyone else that's in their same situation. And you'd wait in this line, and they had these pens, and they had chains on the end with giant blobs of ink on the other end. And you'd fill in this little weird piece of paper called a deposit slip, and you'd wait in line at the bank for about 45 minutes. And then you'd go see Mildred at the counter, who'd been Moses's banker, and you'd say, "Okay, here's my check. Put money here. Pay this bill. Pay this bill. Give me $200 cash back, and I'll see you in 2 weeks." Yep. And that's how we operated. But the thing was, when we had cash in our pockets, if you ever wanted to know how much money you had left, you would reach in your pocket, you would know.
Yep.
Okay. I can't speak to your environment, but I know when I was growing up here in Halifax in the 80s, there was one Tim Hortons on Yonge Street and maybe another one in Bedford. There was one McDonald's, there was one of everything. Mm-hmm. Now it's everywhere. And why is everything everywhere? Because everything has become convenient. And why has everything become convenient? Because spending money has become convenient. So as soon as we rob ourselves of the pain and the effort of getting access to our money, and we make our money easier to spend, then guess what? People spend it. Mm-hmm. When I would say, hey, like impulse aisles didn't exist back then. No. You might see your golden books that were there. I remember that at the Dominion store. You guys wouldn't know what Dominion store was. But, the impulse aisle didn't exist. There's a lot of things that didn't exist because people paid with cash. They knew their budget. They'd go to the grocery store. They'd go with a list. They went in with $100. They spent $100 because that's all they had. Now, if it's 120, oh, okay. And bloop, they tap the card. But by the time you've got out of the grocery store, you don't remember that you spent $120. Yeah. Right. Yeah. Very true. That it very much lends to that capacity of overspending. So when we deal with credit, when we deal with use of credit or use of convenient money, we really have to hold ourselves accountable to say, we have to control the outflow of that money because it doesn't take long for you to forget that, oh yeah, I already bought 2 coffees today. Right.
So as
that third?
As a licensed insolvency trustee, here you have people come to you that they are in a bad financial situation. One of the great things is there's credit counseling, which is involved, but what are your first steps to breaking that payday loan cycle that many people are living in?
Well, we would hope that, of course, if they're coming to see me and they're doing either bankruptcy or proposal, we're saying, okay, well, that's being addressed under this. So you've got that fresh start. You're out of that cycle. So if they've come to me, I'm going to give a finality to that to say you're done. You don't have to go borrow money from them anymore. You now have that reset to say this is the cash that you've been paid. So get used to living off it. For people that are avoiding to come see me, and Wayne, my job is to talk you out of using my services. As a licensed insolvency trustee, my job is to ensure that we've been through all your options before you would deal with me. So do nothing, consolidate, informal arrangements, and everything else. But for somebody who comes to me that has a very small debt load, and it's majority payday loans, we'll walk them through and we'll coach them through to say, okay, this is how you break that cycle. It's my time. I don't charge them for it. It's just, this is what's going to help. And there's really two ways to break the payday loan cycle. The first is to try and wean yourself off of it. Weaning yourself off is the more expensive, is the more costly of options, but it's that kind of thing where you say, okay, you're going in and you're paying back $600. Yes, you have to reborrow. Don't reborrow another $6, reborrow $5. Mm-hmm. Get used to living without that $100. Okay. Then the next week when you go and you repay that amount, borrow a little less and borrow a little less and borrow a little less, and ultimately to wean yourself off of it. And that gets easier over time because, of course, 1 week you're paying $6 to borrow, or you're repaying $6 and you're borrowing $5, or you're borrowing something that's going to cost you $5 to repay. And then the next week next time you're borrowing something that's going to cost you $4 to repay. So it's costing you less money to service the debt. You have less money that's going out. So it's bringing a little bit of a higher heightened element of balance back into your budget. The other way to deal with it is really bad for your credit, but it's really the most cost efficient way. And that comes back to our 60% number. So if we take our example of it costs you $100 a month to borrow, or $100 every week to borrow this $500, you can say, well, in 2.5 months, you will have paid 100% interest, right? Because it would have cost you $500 to borrow that $500. That's why they're not charging you interest. It's a borrowing premium. But if you said, no, I'm not going to pay that $500, I'm just going to stop paying my bill. Well, your contract will typically say, okay, if you default in payments, we won't lend you money anymore. And we will charge you 60% or 59.9% per annum on the debt. That's a scary number. People, oh my God, 60%. That's crazy pants. But think about it. That's per annum. You borrow $100. If they say, well, it's going to cost you $20 to repay, okay, fine. But if you say I borrow $100, I stop making payments on it. They say, oh, we're going to charge you 60% per annum. Well, over the cost of a year, the cost of borrowing on that is $60. So it's actually cheaper in breaking the cycle. Again, if you don't care about the impact on your credit, to actually stop paying it and just pay the interest as it accrues.
That's great
and
advice.
Make a payment arrangement with them.
Yeah.
So you can make that payment arrangement with them and hopefully preserve your credit in that way. Because ultimately, while the payday loan companies, they want to make money, of course, everyone does. Reading that contract, understanding your rights allows you to say, okay, what decision am I going to make? Can I make an arrangement with them to say, I don't want to borrow with you anymore. I just want to pay this off. So I can only afford to pay this much per month. And here you go, or per pay. And here you go until you've weaned yourself off that way. So one way involves you sort of weaning yourself off by staying in good standing with them and preserving your credit. The other one is bad for your credit wise, but it certainly saves you a ton of money.
I think that's just
and the
brilliant.
Third way is to come see somebody like me.
Okay. And you said this during the interview, you said, and it doesn't cost anything to come see you.
Correct.
So they can reach out to you through your website, wecanhelp.ca. And that's not just out of your kind-heartedness. That's actually something that is through the federal government,